Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. The Fed just raised interest rates again this week. The stock market fell pretty sharply after it. We started to see a little bit of a recovery in the market in the days that followed, but investors are looking at their portfolios and trying to figure out what stocks out there are going to suffer from higher interest rates. But even more importantly, I want to make money. What stocks out there are benefiting from rising interest rates? I'm Jason Hall. This is The Smattering. And we've got two of those stocks that we think are going to benefit from rising interest rates. I've got Jeff Santoro on to talk. And I've got Jeff Santoro here to talk with me about them. Hey, Jeff.
Hey, Jason. Yeah, higher interest rates can make investors feel uncertain and worried because generally higher interest rates pull stocks down. But I like to think of the higher interest rates in terms of what stocks can actually benefit from it. So one thing I've been thinking about is higher interest rates are going to mean higher mortgages. Higher mortgages are going to mean less people move. You're not going to trade in your sub 3% 30-year mortgage to go get a 6% mortgage, at least not if you don't have to. So one of the companies I think can benefit from that specific aspect of interest rates being higher are home improvement companies like Lowe's. So everyone knows Lowe's. It's probably within a few miles of everyone's house. And they are absolutely going to benefit because if you cannot move or aren't able to move, you're more likely to do some home improvement projects and fix up the house you have. And the last quarter that Lowe's had, while it did show that it was dealing with some of the challenges that a lot of companies are dealing with, was pretty solid. They grew the revenue 5%. They continued to be very profitable. They did actually have a cash burn on the free cash flow side this one quarter, but generally they are over $1 billion of free cash flow every quarter. Their return on capital is always in the mid-teens or higher. And specifically, one of the things that I think is worth keeping an eye on, they've made a concerted effort over the past couple years to really increase their pro sales. So that means the contractors that you would hire to do the work on your house, they're considered pros. And Lowe's has really been working hard to pull them into their business and cater to them. And the last 3 quarters, they have grown their pro sales year over year, 10% in Q4 2022, 19% the quarter before that, and 13% the quarter before that. So that tells me that when management sets their goals on something, they're able to follow through and really see the result on the other end. So in my mind, for as long as interest rates remain high and people are moving less, Lowe's is going to be a beneficiary from that.
So, Jeff, I think you made a good case for why Lowe's is a company that can benefit from interest rates. I want to say that I think Lowe's is a company that's worth buying right now. Not only are those realities in place, it's an old housing stock in the U.S., so there's all of those tailwinds that are there. But you look at the valuation right now, and it trades for right around 14 times operating cash flow, which I think is a really reasonable valuation. The dividend yield is up to 2% because the stock price has come down. It's a company that's grown its dividend every year for 5 decades at this point. So I think you're absolutely right about both aspects, but I really want to highlight, I think it's a buy right now. Jeff, let's talk about our next stock idea here. And we're going to move into an area that a lot of investors are kind of running from right now, and that's banking. And specifically, I want to highlight a bank that the stock has fallen substantially because it smells a little bit like Silicon Valley Bank that was recently taken over by the FDIC, and that's Live Oak Bank. So Live Oak Bank, the stock has fallen sharply because its primary business, its focus is business lending. Their tagline is they want to be America's bank for small businesses. That sounds terrifying right now. Here's the thing. While they do lend to small businesses, and they've done a wonderful job of building up their lines of lending across industries where they see great economic results, strong profits, and good long tailwinds to drive the growth, they're not like Silicon Valley Bank that counted on their borrowers as also their depositors. The vast majority of Silicon Valley Bank's depositors are regular people that are shopping for the best yield they can get on savings account or on a CD. So that means that it's largely resistant to a bank run of the kind that we saw for Silicon Valley Bank, because there's a big detachment from the people that deposit money in the bank and the people that it's lending money out to. So that's really good. Now let's talk about why it's going to benefit from rising interest rates. Again, this is not a traditional bank that has mortgages and some auto loans and some business loans and commercial and industrial loans and all of those kinds of things. They really focus on lending to small businesses. And the reality is that most of those loans, Jeff, they're adjustable rate. So unlike that 30-year fixed mortgage that Silicon Valley Bank bought, a bundle of that yield 2.9%, every year they are able to adjust up. Live Oak Bank is able to adjust up the rates on its loans. And what that means is that rising interest rates are not just some theoretical thing that it can benefit from. It's legitimately getting benefit from them every single quarter and every month that goes by when loans that it has on its books are levering up based on the Fed's move to rise interest rates. Between the huge sell-off in the stock, the high quality of its business, and that big tailwind from rising interest rates, I think Live Oak Bank is also on the buy list here too.